Buying a car can be expensive, but if you can't always use Uber, there are ways to make owning a car more affordable. Today, we'll share tips on choosing the right car buying approach that could save you up to $7,000. Avoiding dealership traps and sales pitches can help you take control of your car ownership costs. There are 4 main methods to buy a car: outright buying, financing, leasing, and PCP. It's important to be careful when choosing a method, as picking the wrong one might make you pay too much. Each method has its own pros and cons, so let's explore them one by one. Method 1: outright buying. This is the easiest way to get a car. No need for complicated calculations. Just go to the car showroom, book the car, and pay the full amount on the same day. No loans, no monthly payments, just one cash payment, and you're done. Now you own your favorite car. Buying outright has its advantages. No worries about future payments or stress. You own the car, drive as much as you want, and customize it. But there are downsides too. It requires a big upfront payment, and not everyone has that much savings. So, some compromise by buying a cheaper or used car. Still, this method may not be for everyone, as there are other options like financing or leasing. Method 2: financing. In the UK, when you want to buy a car, there's a way to pay for it called the hire purchase method. It's like taking a loan. First, you pay some money up front, called the down payment. Then you pay the remaining amount in monthly installments, known as car payments. These payments include some interest, making the overall cost more than the car's actual price. Once you finish all the installments, the car becomes yours. Now, let's talk about the good and not so good parts. The good things are that you don't have to pay the full price at once, you can choose the car you really want, and you can invest the money you save. But there are downsides too. You have a fixed monthly payment, which can be tough if you lose your job. Also, having too much debt can lower your credit score, so it's best for people with a stable job in a good economy. Method 3: leasing. Leasing a car is an alternative way to enjoy the experience of driving without the commitment of ownership, though it's not as commonly chosen as financing. When you opt for leasing, it's akin to renting a house. You get to use the car, but the ownership remains with the leasing company. As with any choice, leasing has its merits and drawbacks that are worth delving into. On the positive side, the monthly payments are notably lower compared to financing. This is because you are only paying for the car's depreciation during the lease period, rather than the entire cost of the car as with financing. Another advantage is the flexibility to upgrade to a newer car once your lease term concludes. However, there are certain considerations on the flip side. Mileage restrictions come into play since you don't own the car, and surpassing these limits incurs penalties. Additionally, customization options are limited because the car doesn't belong to you. If you're a car enthusiast who enjoys altering the paintwork, tires, or interior, leasing might not align with your preferences. Moreover, repairs become obligatory, especially in the event of an accident. Returning the car without addressing repairs is not an option, emphasizing the need for insurance that covers various damages. This leasing method typically suits individuals who prefer changing their cars frequently to stay up to date with newer models and features. 4. PCP or personal contract purchase. PCP or personal contract purchase blends financing and leasing concepts. Similar to leasing, you can return the car at the lease end. The unique aspect is the option to buy the car for a predetermined value, making you the owner. The monthly payments resemble financing, but with a twist. The buyback value is deducted, resulting in lower payments than financing but higher than leasing. Despite its apparent complexity, PCP is widely favored by car buyers because sellers present it as a win-win: lower payments with ownership potential. Let's delve into cost differences. Assuming a $50,000 car with a $20,000 resale value and a $7,500 deposit, outright buying proves the cheapest. Leasing follows, then PCP, with financing being the costliest. Considerations go beyond upfront costs. While outright buying may seem financially advantageous, it involves giving up the entire $50,000 upfront. Assess the opportunity cost, the potential return on investing that amount elsewhere. PCP's appeal lies in balancing lower monthly payments with the prospect of ownership. Before deciding, weigh factors like upfront payment, investment returns, and your financial strategy. Opportunity costs. The stock market is going up, and interest rates are low. Here's a friendly tip. When buying a car, consider paying just the down payment and invest the rest in the market for better returns. A high resale value is good for long-term ownership. Buying outright or financing is usually cheaper than leasing or PCP. Keep an eye on interest rates. High rates make leasing or buying outright more affordable. Longer loan periods generally mean lower costs. Also, lower depreciation leads to lower leasing costs. Consider the car, dealership terms, and economic conditions when making your decision.